Hello, sisters. I would like to introduce myself. My name is Donna Dietz, and I am a member of the Geneva Ward. I'm going to share my screen today and show you the PowerPoint that I have set up. So hold on one second while I get that all started for us. So this is a big disclaimer at the beginning. This is not a sales presentation, although you'll see Mutual of Omaha at the top of all of this information. I do work for Mutual of Omaha. This is a similar slideshow that they have created. But I am part of the Geneva Ward. My contact information is down here on this first page. And you can call me on my cell phone and contact me by either my work email or my own personal email, whichever you like. If you have any questions that come up during this presentation, feel free to jot them down and give me a call. So with that all said, I'd like to start with my story. So I was a widow when I was 34 years old. I had filed for a divorce, was trying to get through that process when my estranged husband committed suicide and left behind a 12-year-old, 11-year-old, and a 5-year-old sons. And we had been married for 13 years at that point. And some people say, wait, you had life insurance and it paid out when your husband committed suicide? And that is true. Most life insurance pays out if you've had the policy for more than 2 years, even if there is a suicide. So we were fortunately very blessed in that regard. However, we bought that insurance policy 13 years before he died. And the disadvantage that I had is no one ever reviewed that policy with me. So I spent 13 years with one policy. And as much as I'm grateful we had it, I should have reviewed that because my life had changed a lot in 13 years. I had 3 children and he had a business. So there were a lot of expenses that we had to take care of. So I was grateful to be able to have that life insurance policy. It helped pay the rent on his place, his shop for a while we cleaned it out, helped me to pay for a funeral. So we're going to discuss what is life insurance, why do you need it, who needs it, and what kind they are. So let's get started. This basically is the foundation of insurance. And if you look at this, you might be a little overwhelmed by all these different things that you need to have as a foundation for insurance. But I think any wise financial plan has this as a foundation, is all your insurance pieces. So just take a look at that. You can take a picture of it with your phone if you want, so you can kind of check off what you have. But health insurance, to me, most important. Disability insurance, also extremely important. Disability insurance basically provides a paycheck when you can't. So when you get injured or sick and you can't work for a while, it provides a portion of a paycheck for you. And then, of course, life insurance is what we're going to talk about, where if you are no longer here to care for your family, you're going to need to have life insurance. So what is life insurance? Basically just provides money for your loved ones when you are no longer here to be able to take care of them. It can assist any financial obligations that the family who's left behind has, because your financial obligations don't necessarily end just because you passed. So it's really important. It helps to meet current financial obligations as well as future ones. And we're going to talk a little bit about what some of those future obligations are. So to start with, what types of life insurance are there? The first one is term insurance. I'm a really big believer in term insurance, especially when you're young and you need to start out with something. I'm a big believer in something's better than nothing. So start with term insurance. You can get a lot of it for very inexpensive. So just throw out there $1 million in term insurance, a young 20-some-year-old can get for $30-some. So it's really a very cheap, short time period policy though. When it says term, it's because it's a term. It's 5 years, to 30 years, and you get to pick the numbers in between there based on the insurance company. It doesn't build any cash value. It is just a life policy. And it can be converted. So one of the great advantages to a term policy is you buy it when you're young and healthy, and you get this really good health rating. And so your insurance is really cheap. But later in life, you decide you really want to have one of these permanent insurance policies that's never going to outlast you. So it's going to last until the day you die. Well, you can take a piece of that term insurance policy and flip it into a permanent policy. And you don't have to go through any underwriting questions. So there's no medical exams. They just will slice off a piece of that previous policy and move it over to a permanent policy. And the best part about it is you get to get the health rating that you had back when you were 20 or 30 or 40 years old. So that's a great gift. And that's what I love about the term insurance policies. The permanent policies are designed to be that. They're designed to last your whole lifetime. They also can build some cash value. They can build enough money that some people even overfund a permanent policy and then use it later in life to pay for a person to go on a mission or for retirement or to pay off college. So those are some different things that you can do with insurance, permanent or term. So let's talk about who needs life insurance. So basically everybody needs life insurance, whether you're a family, an individual, a senior, small business. We're not going to talk about large estates, but if you have a large estate, you definitely need to have life insurance. So starting with families. Families need to have life insurance for a few reasons. I call it DIME, is how I remember what the four main areas are that people need life insurance for. Number one, the first one is to pay debts. The second one is for an income continuation. Third is mortgage, and fourth is education. So obviously debts are pretty explanatory. If you have student loans, credit cards, medical bills, those are debts that a life insurance policy can help pay. Now, just as a note to some of the parents in the room, if you have co-signed for students, for student loan debt, and your student were to die before they paid off that debt, if you are a co-signer, you are obligated to pay that debt. So a lot of parents don't think about this, but that's a great time for you to go get a life insurance policy for your college student, is when you have signed for a loan for them, so that you wouldn't have to have that debt yourself. Another area is that income continuation. So if you are counting on 2 paychecks in your home to pay for all the bills in your home, you really need to have life insurance that's going to cover and replace that other spouse's lost income should they die. So think about that. It's really very important. How do we replace that income? The mortgage. A lot of people will say to me right now, I don't have a mortgage, I just rent. Well, is your family going to keep staying in the apartment or the townhouse or the condo that they're renting? Yes, they're going to still need to have that rent paid. They're going to still need to have the mortgage paid. They're going to still need to pay the taxes on the house. So don't think that the mortgage is done if the house gets paid off. There still are taxes that need to be paid. And the family's still going to need to keep living there for 10 or 20 years. So it's really important to know that, and to have the comfort and peace of mind to know that your family doesn't have to move in the first month or two after somebody passes. That's the worst thing, is to have somebody just up and leave and have to get kicked out of their house because they don't have enough money to pay their mortgage or their rent. Another area is education. And some parents say, I had to pay for my own education. I'm not paying for my kids to go to school. They can save their own money. And that's a fine thing. But some of us, if we weren't around when our children need to go to college, may want to be able to have their kids have some extra money for that. The other thing that I always think about in this area is maybe you have a kid who doesn't decide he wants to go to school. Maybe you have a child who just goes to a junior college or goes to a trade school, so they don't need large sums of money for an education fund. But maybe you have a child who wants to start his own business. Wouldn't it be nice for you to be able to have a bucket of money that you could draw from? And you could do this with a permanent policy. You could draw from that and make it a loan basically to the child for their education fund or to start their own business. And lastly, the special needs children. We all know people who have special needs children. And if a child is a special needs children, they're going to need care for the rest of their life. They're not going to grow out of that need. And so if the parents are no longer there, who's going to care for them? They might end up going to an older sibling or another sibling. Well, that sibling's going to either need to hire someone to care for them or they're going to have to quit work. So how is all that funding going to be provided for? So that's one of the things that we have to think about too if we've got special needs kids. A lot of people tell me they don't need life insurance when they get older, and then they have a life experience of either having a funeral for a loved one and having to do a GoFundMe page, or having seen their friends have some serious financial problems because their spouse passed. And that's usually when they will call, and they're usually older, and it's really expensive to buy insurance when you're older. Remember that $1 million term policy I said you can get at 30 for some $30. Well, when a senior needs to get 10,000 in insurance, they're going to spend anywhere from $50 to $75 a month, depending on how old they are. That's a big cost for just $10,000. So let's buy our insurance early. These are the things that life insurance is needed for when you're a senior. It's final expenses. It's to pay off medical bills. But the biggest one is this income replacement. When we are living on Social Security, there's 2 paychecks coming in the house if there's 2 people on Social Security. But as soon as one of those people die, that second paycheck goes away. And the person in the house can only keep the largest check. And so that is a huge hole and a huge gap that happens in this family. And so that's one of the things socials or a life insurance policy can really help with. Lastly, and I won't spend a lot of time on this, but if you are a business owner, there are some very important reasons to have life insurance. And I'm just going to touch on these first 2, but the key employee and executive bonus are just really important pieces. And you're welcome to give me a call if you want to know some more about this. But basically, the key employee is just if I have a person who's like my best salesman, and if he were to die, my business would be really negatively impacted. I can actually buy a life policy that will allow me to get an income while I'm trying to replace that person. The executive bonuses are pretty cool in that a lot of employers will buy a life policy for the executive, and it will be a way to fund a retirement fund for them. And it's just an attractive piece for an executive. So we can talk about that some other time if you're interested. So how much life insurance do you need? That is an absolute individual question. So like we talked about all of the different things, the dime, the debt, income, mortgage, education funds, you need to consider all of those things. There are a lot of calculators out there in the world. I have a great worksheet. I'd be happy to email anyone if they'd like to have that. My experience is when you do that worksheet, you'll come up with a little bit of money that you need to have insured for. But most of the time these days, anybody who has any family usually needs close to $1 million of insurance. And that's really doable if you start out with that term policy. So don't be afraid, but just make sure that you have something. So something again, so I said at the beginning, something is better than nothing. So get insurance, life insurance for yourself. And again, if you want some help finding some of those calculators, I'd be happy to help you with that. One of the other benefits of life insurance is what's called living benefits. And a lot of insurance companies have this. And basically what it is beyond just paying for death insurance, like upon death, it has this before you die benefit. And this is called chronic or critical illness benefits. A chronic illness would be, for instance, if I have a stroke and I am going to need to have constant care coming in my home or occasional care coming in my home, maybe helping me bathe or helping clean my house or prepare my food. If I need that kind of chronic, or I have a chronic illness and it's going to continue to go, then I could actually take 80% of the face value of my policy out while I'm alive. So think about that. $1 million policy, I could have access to $800,000 of that money while I'm living. It could help pay for a caregiver. It could help pay for some of my bills ahead of time. It could help pay for some of my, maybe my physical therapy or some special treatments that I want to have if I want something special for maybe a cancer treatment. So the critical illness is, I've been told, it would be if you've been told that you have less than 12 months to live, that would qualify as a critical illness. So those benefits are on almost all life insurance policies these days. So here's some questions for you is, how much do you need? The big question is, how much can you qualify for? So people don't think about this, but you actually can only get so much insurance. It's based on how much how much salary that you make. It's also based on your assets. So I can't just go out and decide I want a $10 million policy if I'm only making $20,000 a year. The insurance company is not going to give me that. So it's really important for you to calculate out and find out how much do you qualify for, as well as how much can your budget allow. So those are important questions to ask. Lastly, again, who needs life insurance? Everybody needs life insurance. So I want to close by just having you look at this paper here, these pictures. These are all people that I love. These are families and places. And life insurance can give all of this. It can give money for retirement. It can give money for college. It can provide automobiles. It can provide homes. It can provide weddings to be paid for. It really is for anything that people left behind and those that are living need to have cared for. So I want to close with one last story. And this is about a friend of mine. Her name, we'll call her Pat. When Pat was 16 years old, her parents went out for a date. And yeah, this isn't going to turn out well, but Pat had a knock on the door that evening and 2 policemen were at the door. They asked if there was an older sibling at home, and there was. So they all sat down and the policeman informed them that their parents had died in a car accident. Because their parents had strongly and diligently paid for insurance and had lots of life insurance throughout the years, they had bought multiple policies and really had prepared for such an event. They had plenty of money to be able to maintain their lifestyle. Pat, like I said, was 16 years old. She was going to a private parochial school, and she did not have to change that. She did not have to move out of their family home. One of the siblings came home, was able to still go to college. Pat was able to go to college. Pat was able to have her marriage paid for, her wedding, her college, her high school. Everything was still paid for because her parents had provided by having adequate life insurance for their family. And I think about that when I look at this picture that I created of all of my family and different places and events and things, that all of those things can still be done even if somebody passes. It's a loss and we all miss that person, but our lives need to go on. And I never wanted my boys to hear, we can't do that because there isn't money. I'm sure I said that many times, and if they heard this today, they would say, "You always told us that." But I wanted to know that there was money available if there was something that was really important to my kids. And Heavenly Father expects us to be good stewards of our money and the blessings and the things that He gives us. And one of those things is to have a budget and to live within our budget and live within our means and to provide for our family that we have. And I just really want to bear my testimony of the importance of being good stewards. And I know that Heavenly Father will continue to bless you as you try to provide for and protect the assets and your family. And I say these things in the name of Jesus Christ. Amen.
Hi, I'm Tami Haroldsen from the Naperville 6th Ward. I'm the CFO for Summit, a software company in Naperville. Prior to working at Summit, I was a personal financial planner at Harris Bank and Arthur Andersen in Chicago. I'm going to share my screen with the presentation. There we go. So today we are going to review some basic suggestions for personal financial planning. Please consult your financial advisor and/or attorney for advice on your particular situation. So the First Presidency issued a letter on March 7, 2013, and said the following: "We are concerned that some church members ignore the oft-repeated direction to prepare and live within a budget, avoid consumer debt, and to save against a time of need. Consideration should also be given to investing wisely with responsible and established financial institutions." So we're going to be covering several topics today. Donna Dietz has already done a great job covering insurance, so we won't be talking about that on this presentation. We'll be talking about the following: wise financial principles and practices, investment planning, education funding, retirement planning, and estate planning. Wise financial principles and practices. Always pay your tithing first and your fast offerings. Record how much money you earn and spend and create a budget. Don't spend more than you earn. You need to determine your needs versus your wants. And do not covet. That just leads down to discouragement. If you can't afford it, don't buy it. There used to be a sketch comedy show, and they had a little mini commercial about this pamphlet you could order. And people would be like, "Oh, I really want this, but I don't have the money for it." And they'd say, "Well, you need this pamphlet. If you can't afford it, don't buy it." Now, I joke. Sometimes there are some situations where you really may actually need something, you don't have the money. But we're just talking here about things that you really can't afford and you really should not be buying. So sometimes I'll go like, I'd really like that. Nope. Can I afford it? Nope. Okay. I shouldn't buy it. All right. So if your budget is out of balance, you will need to either increase your income or decrease your expenses, or maybe a little of both. So you should also avoid unnecessary debt. So you should save for your large purchases and buy them when you can do it without the debt. Credit cards are okay if you pay them off every month. If you can't pay them off every month, you shouldn't be using credit cards. You should instead use cash or a debit card. The thing to remember is with credit cards is you should earn credit card benefits, not accrue interest on your credit cards. In 2009, Elder Hale said in his general conference address, he said that these following items are okay for to incur debt. They are education, which is reasonable, modest home, and a basic automobile. Thing to remember is you should always pay off your debt as soon as you reasonably can do so. So another thing to do is save for emergencies. This is called an emergency fund. Our area church authorities recommended in the April 2021 Naperville State newsletter to have 1 month of emergency supply of living expenses for 1 month. Now, financial advisors typically tend to recommend an average of 3 to 6 months of living expenses to be saved up. Now, this should be liquid. That means it's either in cash or easily converted to cash with little risk of principal loss. So what this means is not in the stock market. Yes, you could redeem your stocks pretty easily and get the cash, but what happens if the stock market crashes the day before you do that? So should be kept mostly in cash accounts or checking, savings, things like that. You can also use staggered CDs that can provide a higher return than bank accounts. Now, right now, CDs have very, very low interest rates, but once interest rates go up, which historically we know they probably will at some point, you can use those. If you have questions about that, reach out to me. My email address is listed at the beginning of the presentation, and I can go over that with you. It'll take a little more time than we have here. But just a general summary, if you want 3 months of living expenses, you have 3 CDs each that comes due at the beginning of each month or middle of each month, whatever you want, but they're spaced 1 month apart and you just rotate them. And if you want 6 months, you do it for 6 months. So like I said, we can talk more later if you're really interested in that. So if you do have a windfall in, funds that you receive, save it instead of spending, or at least part of it. So another thing is to plan for your future. So after you pay your tithing and fast offering, you should pay yourself by saving for your goals. Some examples of these are large purchases such as a house, vehicle, vacation, etc., education for your children and or your grandchildren, missions for children and yourselves, care a special needs child, long-term health issues, and retirement. So when you're faced with challenges to savings, ask yourself, do we really want to buy that thing now or do we want blank later? Our next topic is investment planning. So one of the things with investment planning is called asset allocation. It's investing in different types of asset classes in order to reduce risk and enhance return. So some examples are cash, bonds, domestic stocks, foreign stocks, real estate, intangibles such as gold, stamps, coins, things like that. So how much should be invested in each type of asset class is based on your time horizon for investment and how much risk you are willing to bear. So for example, when you're younger, you can usually afford to have more stocks in your portfolio because you have a longer time horizon. And even if the stock market dips, you could have time to have it regain and not be so bad. Typically, as you get older, you get more in what we call fixed income investments, such as bonds. But you still may want to have some stocks in there to give some potential for growth because bonds typically do not have that. Dollar cost averaging is purchasing the same dollar amount of securities at certain intervals to reduce the impact of security price fluctuations. So for example, you'd invest $100 per month, no matter what the price is. What you can do to make this simple and easy for you is you can set up dividend reinvestment plans. So if you have a stock that pays dividends, not all of them do. A lot of the, larger or younger tech type companies will not pay dividends because they want to reinvest the money back into the company to help it grow. But for companies that do pay dividends, you could just say, okay, every time we get a dividend, it's just going to be reinvested back into that stock. And so that way you can spend out or spread out that investment over time, but always doing the same amount. So it reduces some of the risk. If you're constantly trying to time the market, that can be risky and that can be difficult, especially if you are not a knowledgeable investor. Another aspect is diversification. So it's the process of investing in different securities to reduce the risk of loss. So, for example, you'd buy stocks in different types of companies as opposed to putting all your money into one stock. When we were doing retirement planning and investment planning for large wealth individuals who were executives of large corporations in Chicago, we'd often have a challenge because they were all like, well, I want it all in X company stock because that's the company I know. I'm in that company and I just want to invest all there. And we'd always be like, whoa, wait a minute. What happens if something happens right before your retirement and it drops in value? And they're like, oh, okay. So that's a situation where it was kind of difficult to convince them to do it, but it is a good thing to do, is to have not have all your eggs in one basket, let's say. So one way you can do this is through mutual funds. So you can pick a fund that has different stocks and different types of companies, and that can help reduce your risk. Because sometimes when the stock market goes down, some companies go up, but others go, or some go down, but some go up. So for example, in the last year with COVID, some companies really struggled and didn't do as well, but other companies did very well because they were able to um, meet the needs of what was needed at the time. And so they actually did very well. So it really is good to diversify your portfolio. So you can also have tax exempt investments. They do typically have lower returns on average than taxable investments. And the reason being is because you can save money on taxes. They don't have to pay as much because you're getting that tax benefit. So today is easy to do your online or own investing online. However, be sure you do your research and be aware that there are no guarantees when investing, especially in the stock market. Education funding. So the average annual increase in college tuition in the recent years has been 5 to 10%. So some examples of annual college costs, which are this list includes tuition and room and board. BYU Provo is $13,778 a year. University of Illinois in Champaign is $27,644 a year. Northwestern is $73,902 a year, and University of Chicago is $74,646 a year. That's a year, not for a 4-year degree. So financial aid and loans may be available, but they are mostly needs-based and are dependent on your income and assets. The most popular way to save for education is a 529 college savings plan. Many websites have information on ways to save for college as well as financial calculators. Retirement planning. Start saving early and save as much as possible. But remember the man or woman who worked the entire life for retirement and died the day before the retirement. Social Security is not enough to sustain most people's lifestyles. And that is very, very true. If you think it is, you'll be surprised. You can go to calculators online to determine what you'll get, and you'll be surprised how little it actually is. So one thing you can do is utilize your company's 401k plan. So in 2021, the employee contribution limits are $19,500 for people under 50 and $26,000 for people 50 and over. You could also set up an IRA and fund that. You can have a traditional IRA where contributions are made with pre or after tax dollars. Growth and earnings are tax deferred, and withdrawals are taxed as current income after age 59 and a half. Other criteria do apply or may apply. That's the case for all these things that we're talking about. So make sure that you do further research before you jump into these and know fully what is expected and required. Roth IRAs, those are contributions are made with after-tax dollars. The growth and earnings are tax-free, and withdrawals are tax and penalty-free after 59 and a half. Once again, other criteria may apply. In 2021, contribution limits for both types of IRAs is $6,000 for people under 50, $7,000 for people 50 and over. There's also income limits that apply for your contributions. So if you go to the IRS website, you can get more information on that. So what's interesting with retirement planning is the beauty of compound interest. So if you start saving young, you get a far bigger bang than you do if you start when you're older. So here we have an example where you invest $200 per month with an 8% return. If you start at age 25 through 64, your value at age 65 will be $671,474. But if you start at 35, so 10 years later, so 35 to 64, your value at age 65 is $293,630. So your account balance will be $377,844 higher if you just invest an additional $24,000 over those 10 years from age 25 to 35. So it makes a huge difference. So the message here is if you're young, start investing now and save for your retirement. And if you're older, it's better to start sooner rather than later, so start now. Estate planning. So you have some basic documents that everyone needs. One is a will, and the ability to have a will is a privilege granted to us. If you don't take advantage of it, the state will determine how your assets are distributed and who will be the guardian of your minor children. A living will is a document which indicates your desires regarding your medical treatment in circumstances in which you are no longer able to express informed consent. This includes do not resuscitate and other treatments. The durable power of attorney for healthcare is a document which indicates who you want to make health decisions for you, including decisions to withhold or withdraw life support. Now, these documents you can go online and get online resources for free at or low cost. However, if you have a more complicated situation or large amount of money is involved, an estate planning attorney and an accountant are recommended. So the reason why you want to do some estate planning is, especially if you have a larger estate taxes may kick in. So you have federal taxes and state as well. So the federal estate tax is a graduated tax rate up to 40%. The current federal lifetime exemption from estate tax is 11.58 million, but is scheduled to go down to 6 million in 2026. And most are expecting that to happen because the current administration is not as interested in keeping that higher lifetime exemption. Um, Also, there's unlimited gifting to surviving spouse or charitable organizations. So this means if you give your money to a charitable organization, whichever one qualifies under the tax code, or you pass it to your surviving spouse, there is no estate tax. Another way that you can reduce the size of your estate is to use lifetime gifting to others. So in 2021, the annual gift tax exclusion is $15,000 per donor per recipient. So that means you can give that amount to someone before you have to worry about any gift tax implications. So amounts over that could be subject to federal gift tax depending on your situation. This is not meant to be a complex estate planning course, so we're not going to talk about more details about that. If you fall into this situation, you'll need to consult an expert about that. All right, so Illinois also has a estate tax. They are one of 10 states with one. That is a graduated tax rate up to 15%, but legislators are considering raising it an additional 5%. And this applies to estates greater than 4 million. There is no gift tax in Illinois. So keep in mind that there is quite a difference between what is taxable by the federal government and is taxable by the state of Illinois. There's a lot of argument in the state legislature to not um, allow the rate to be raised, or also they're recommending to increase this minimum here of the 4 million because it can be very difficult for family businesses and also for family farms. You could, barely be getting by, but the actual value of your business or farm could be over $4 million, and it might have to be sold in order to pay estate taxes. So we have a lot of different resources that the church has provided for us. These are just a few here. So the conference address that I was referred to when I was talking about Elder Hale's quote, that's listed here from April 2009. The church has a great website on Provident Living that you can check out as well. And there's some other articles that kind of give you a good spiritual perspective as well as just basic financial perspective. Because, of course, most of what you will find online will be more from a financial perspective. There are other people who are known for financial planning, and they have websites, they have methodologies, they have materials you can buy. I'm not going to endorse anyone in particular, but feel free to do your research, and if you feel comfortable with those, go ahead and do so. We also have some other free resources. I was talking about online. You can find a lot of things. There's a basic financial literacy guide. This one's really interesting. It's a subscription service, but this particular page is free. Now, it is targeted toward college students, so it talks a lot about the needs at that age. However, it can apply to anyone, even down to high school. One of the complaints that has been circulating around lately is we focus so much on education in our, under college age, but also college age to get degrees. But what's often missed is just basically consumer economics, how to survive in the world. How do you do basic things? How do you open an account? How do you set things up? How do you apply for a mortgage? Things like that can be very stressful for people. And so just these basic guides are very helpful just to give a little bit of guidance to get things going. And then if you want to learn more about any of the other topics, feel free to search for those with your favorite browser, whatever that may be. There's a lot of free information available, but keep in mind that most of the free information, those websites also have advertisements. So be aware of that. That's once again why I'm not necessarily encouraging any particular one, because you will be faced with that situation. Sometimes they may be general ads, but they also may be ads to purchase their services. So once again, please consult with your financial advisor and or attorney for advice on your particular situation. So we are expected to be wise stewards of our resources and care for our families. That takes planning and effort. Financial planning is truly a process. It also changes over time based on your current situation and needs. For example, what you set up when you were younger and had lower income and fewer children may not be what will meet your needs now. This may all seem overwhelming, but you can counsel with the Lord and your family to determine what actions you can take now to move towards your goals. Remember, if ye are prepared, ye shall not fear. I say these things in the name of Jesus Christ. Amen.